One of the highlights at the Cattle Industry Convention every single year is the CattleFax Market and Weather Outlook Seminar. And here in New Orleans, the take-home message, tighter supplies equals higher prices. Now joining us here on Cattleman to Cattleman from CattleFax is their Kevin Good. And as I mentioned, boy, you guys were talking about the supply shock that the beef cattle industry continues to witness and was reaffirmed just this week by the latest USDA cattle inventory report. Bottom line, though, these tighter supplies are in fact going to mean higher prices for producers.
Absolutely, and we're already trending higher from the COVID lows of 2.5 years ago, so we're already trending. The supply side of the market does look extremely friendly. Let's remember that last year was still record beef production because of drought. You know, we liquidated a lot of cows, and also we've pulled the feeder cattle and calf supply forward over the last couple of years too. So it is going to be kind of a supply shock as we go through this year and beyond. We're forecasting nearly a 5% reduction in beef production this year, and obviously over the next couple of years it'll get tighter yet.
Maybe describe a few of the classes of cattle and what that means in terms of actual dollars and how high or how much higher they're going to be versus just a year ago.
Oh, absolutely. We started the Fed market in here, and last year we averaged 144, and this year we're forecasting to average 158. We can even start back before that and talk about beef prices because it's all translating into still record high beef demand. Retail prices this year we're forecasting to be up only 1%. Wholesale, the cutout, up 4%, but fed cattle up 10%. So it's a margin realignment as we get into tighter supplies. More of those record dollars at retail will trickle back to the fed market at 158. That will trickle back to a stronger yearling market at 195 and to a stronger calf market at 225.
Well, it's certainly been long overdue, and more profitability obviously is some good news for America's beef cattle producers. But even with that said, there are still a few headwinds in the industry.
Well, absolutely, and it starts with the weather patterns, which are in the process of changing. That's positive. But other than that, we think about input costs, whether it's feed, whether it's labor, not only cost but availability. Interest rates are huge as they've bumped twice as much as they were just a couple of years ago. So all those are headwinds for our producers. We still are optimistic that prices will move high enough over the next couple of years to be profitable and start to rebuild the factory. But at the same time, short term at least, we've got to get into better shape from a weather standpoint, number one, and then obviously some of those input costs are going to continue to be a headwind.
And finally, Kevin, here at home, consumer demand remains strong for U.S. beef, but around the world, those consumers are also still loving delicious U.S. beef.
Absolutely. If we just look in the rearview mirror at 2022, we had record beef exports by tonnage and also value. And if you think about the value of what we export, it's about 23% of the value of a fed steer heifers exported, record high. As we go from this year forward, obviously with tighter domestic supplies and higher prices, that'll be a headwind for exports. But we're still optimistic that exports will hold together rather good this year. Tonnage-wise, maybe down a couple notches, but dollar value, probably still a new record this year again.
Well, we always appreciate your insight, and thank you for joining us here on Cattleman to Cattleman.
Thank you. Good to be with you.
All right. So, if we can get a little bit of help from Mother Nature, and we can get some lower input costs, at least according to the CattleFax team, things are looking awful good, at least for the next few years for the U.S. beef cattle industry and all of its segments. For more details, you can always visit CattleFax.com.